This is Catherine Morgan-Nance. Welcome back. Part 3 of our video series covers production and direct material budgets, along with the accompanying schedule of expected cash disbursements for direct materials. These may be the most complicated budgets we will discuss, primarily because of the impact of beginning and ending inventories. Let's get started. After we have budgeted our sales and our expected cash collections, we must make sure the production budget is adequate to meet the forecasted sales and to provide for desired ending inventory. We need inventory on hand at the end of the period to minimize the likelihood of an inventory stock out. We call this inventory on hand safety stock. Those of you in materials management may recognize the term. Assume the management at Royal wants to minimize the probability of a stock out of inventory items. A policy has been implemented that requires the company to maintain ending inventory of 20% of the following month's budgeted sales. At the beginning of the quarter, Royal had 4,000 units in inventory. And remember, July sales are forecast to be 25,000 units. Let's get started on the production budget. The production budget is a units-only type of budget. There is no cost. We're just coming up with production quantities. The quantity produced should be based upon the quantities you expect to sell, adjusted for beginning and ending inventories. Thus, the first step in preparing the production budget is to insert the budgeted sales in units from the sales budget. Next, we consider the impact of our 20% inventory stockout policy on production needs. And we also take into consideration beginning inventory. After all, if we have inventory in the warehouse at the beginning of the period, then we don't have to make it, right? Notice the desired ending inventory in units for April, 10,000 units based on 20% of May sales of 50,000 units, and the beginning inventory in units for April, 4,000 units. We calculate the required production in units for April, that's 26,000 units, by starting with sales of 20,000 units, adding ending inventory needed of 10,000 units, and subtracting the beginning inventory of 4,000 units. We repeat the process for May, that's 46,000 units that we end up with, and notice April's desired ending inventory of 10,000 units becomes May's beginning inventory. Hopefully that makes sense. For June, we perform the same procedure and calculate required production of 29,000 units. Notice we are assuming a desired ending inventory of 5,000 units. This implies that projected sales in July are 25,000 units because 20% of 25,000 units is 5,000 units in ending inventory. Now the final step is to complete the quarter columns. Notice April's beginning inventory and June's ending inventory are carried over to the quarter column. Pay attention to this. The beginning inventory in April is also the beginning inventory for the quarter, and the ending inventory for June is also the ending inventory for the quarter. This makes sense if you think about it for a moment. For the quarter, we will need to produce 101,000 units to meet our sales and inventory goals. And now that we know our required production, let's look at the direct materials budget. The direct materials budget is a bit more complicated because we have units produced and we have to turn those into the quantity of raw materials needed to support production. In this case, assume each good unit of output requires 5 pounds of direct material. Management doesn't want to run out of direct materials, so a policy has been established that materials on hand at the end of the month must be equal to 10% of the following month's production needs. At the beginning of the month, Royal has 13,000 pounds of direct materials on hand, and at June 30th, it has 11,000 pounds of material on hand. Each pound of direct material costs 40 cents. So let's take a look at the direct materials budget. The first step in preparing the direct materials budget is easy. Just start with the required production in units coming from the production budget. The second step converts the finished goods quantity produced to the quantity of direct materials needed to support production. In other words, we must calculate the monthly and quarterly production needs, which in this case are stated in terms of pounds of direct material. Multiply finished goods production by 5 pounds of direct materials per unit to come up with the pounds of direct materials needed to support production. For April, for example, 26,000 units times 5 pounds per unit equals 130,000 pounds of materials. A word of caution, you're not done. This calculation is a starting point. It doesn't consider beginning and ending direct materials inventories. The third step then is to calculate the materials to be purchased for April, and we come up with 140,000 pounds. This is an important calculation because we need to ensure our vendors know how much we plan to buy from them. And this calculation also helps us determine how much we're going to spend for materials. The impact of beginning and ending direct material inventories are also visible here. It should remind you of what we did in the production budget. Specifically, April's desired ending inventory is equal to 10% of May's production needs, or 23,000 pounds. The total number of pounds needed in April is 153,000 pounds. But finally, we subtract our materials on hand, beginning inventory of 13,000 pounds, to determine the number of pounds of material that we must purchase. So during April, Royal must purchase 140,000 pounds of direct materials. Can you calculate the materials to be purchased in May? Pause the video for a moment and see if you can compute the answer. If you answered 221,000 pounds to be purchased in May, you're correct. Notice that April's desired ending inventory becomes May's beginning inventory, and May's desired ending inventory of 14,500 pounds is 10% of June's production needs of 145,000 pounds. We calculate the materials to be purchased for June, 142,000 pounds, in a similar fashion. The desired ending inventory for May becomes the beginning inventory for June. We are assuming a desired ending inventory for June of 11,500 pounds in our facts. As we discussed when reviewing the production budget, April's beginning inventory and June's ending inventory carry over to the quarter columns. And let's move on to the last part of this video, expected cash disbursements for materials. This calculation is important because it's used in the cash budget. Recall that Royal pays 40 cents per pound for direct materials. I calculated the total value of the purchases each period for you here by multiplying the expected pounds purchased by 40 cents per pound. Assume the company pays for 1/2 of its purchases in the month of purchase and 1/2 in the following month. At the beginning of the quarter, Royal owed creditors $12,000 for purchases of direct materials, which it will pay for in April. The first step in calculating Royal's cash disbursements then is to insert that beginning accounts payable balance of $12,000 into the April column of the cash disbursement schedule. This balance will be paid in full, as I said, in April. Next, we calculate the April credit purchases that will be paid during each month of the quarter. In April, $28,000, that's $56,000 times 50%, will be paid, and the remaining $28,000 will be paid in May. As a reminder, the $56,000 is derived by multiplying 140,000 pounds purchased, see the direct materials budget, by the 40 cents per pound purchase price. Now it is time for you to go to work. See if you can complete the expected cash disbursements for materials for the quarter. Stop the video and complete the schedule for the quarter and see how your work is progressing. Continuing in the same fashion, the remaining steps include calculating the May and June credit purchases that are paid during each month of the quarter. We also calculate the totals for all columns in the schedule and the total for the quarter, which is $185,000. The total cash disbursements row can be added across to equal the total cash disbursements for the quarter. In the next video, we will start then with the direct labor budget before preparing the manufacturing overhead and the selling and administrative budgets. See you shortly.